Y'all ready for this? Let's go.
Hello and welcome to the Ben James Smith podcast. Today I want to talk about something that most people misunderstand about investment firms, and it's actually the difference between a platform that survives and one that disappears. When people think about investment managers, they imagine profits come from successful exits, big deal closes, big paydays, carried interest, but that's not how enduring investment platforms actually operate. The truth is, if a firm depends on exits to survive, it isn't an investment platform. It's a project, and projects eventually end. Platforms don't. So today we're going to talk about the economics of real investment businesses and why the most stable ones generate cash flow long before performance upside ever arrives. Part 1. The myth of exit-dependent businesses. There's a dangerous illusion in private markets. People believe success equals a profitable sale. And yes, performance matters, but performance is not what keeps a firm alive. Time does. Investment cycles are slow. Assets take years to mature. Markets pause. Liquidity disappears. If your operating model requires a successful exit to fund your business, you're not investing. You're waiting. And waiting is not a strategy. Professional allocators understand this deeply. They don't ask, can this investment make money? They ask, can this organization survive long enough for the investment to make money? Because survival precedes performance. Part 2. The architecture of durable platforms. Real platforms are built differently. They are designed so activity generates income, not outcomes, meaning the firm is paid for doing the work of investing, not just the result of investing. Why? Because disciplined investment requires patience, and patience requires financial stability. So enduring managers structure their economics around the life cycle of capital, not the liquidation of capital. And this creates multiple layers of revenue that exist regardless of market timing. Let's walk through them. Part 3. The 4 layers of platform economics. Layer 1. Capital formation. Before capital is invested, it must be structured. Documentation, onboarding, regulatory processes, investor management, all of this is work. Institutional platforms don't treat fundraising as a marketing event. They treat it as an operational function, and operational functions sustain businesses. Layer 2. Deployment. Once capital exists, it must be deployed responsibly. Sourcing, underwriting, structuring, execution. This stage is intensive, and importantly, it has value independent of outcome. A disciplined investment platform creates economic activity simply by allocating capital correctly. That activity sustains the organization. Layer 3. Asset oversight. Now we reach the longest phase, the holding period. This is where risk is controlled, not returns chased. Monitoring, reporting, governance, protection of capital. This stage can last years. If a firm earns nothing during this time, it weakens itself precisely when discipline matters most. Professional platforms therefore earn income from stewardship, because safeguarding capital is work. Layer 4. Performance participation. Finally, the reward for patience and discipline. But crucially, this is not survival income. This is alignment income. The platform doesn't depend on it to operate. It benefits from it for doing the job well, and that distinction changes behavior dramatically. Part 4. Why this matters. When a firm relies on exits to pay salaries, pressure appears. Deals must happen. Sales must occur. Timing gets forced, but when a platform generates operating income through its activity, something powerful happens. It can wait. It can say no. It can protect capital instead of chasing valuation. And investors rarely articulate it this way, but they instinctively trust organizations that are not economically desperate. Because desperation destroys judgment, stability protects it. Part 5. The real purpose of platform economics. The purpose isn't to maximize fees, it's to remove pressure. A properly structured investment business aligns time horizons between the manager and the investor. Both parties benefit from patience, both parties benefit from discipline, both parties benefit from durability. And when those incentives align, trust compounds. So, when evaluating an investment platform, one of the most important questions isn't about projected returns. It's this: does the organization earn income from activity or only from outcomes? Because outcomes are uncertain. But disciplined activity is repeatable, and repeatability is what turns a manager into a platform, and a platform into an institution. Thanks for listening. And remember, the strongest investment businesses aren't built to win quickly, they're built to last long enough to win inevitably. I'll see you in the next episode.